Hi, I'm Pattu from freefincal. On the 14th of October, the Nifty PE was 34.87, which is an all-time high from the 1st January 1999. The current PE is a touch less, so investors are worried about the PE being so high and whether this would actually bring on a market crash. So we're going to look at the historical PE and what can be learned from it. So the data I'm going to show you can be done for any index using the Nifty PE tool that you can see in the menu, and it's also linked in the article. You can get the tool. You can use it for analyzing PE, PB, dividend yield, moving averages, Bollinger Bands, RSI, and a couple of other indicators. So that's the Nifty PE tool right here. Alright, so this is the Nifty PE graph with the 10-year rolling returns and the standard deviation bands. The blue is the Nifty PE. The red line right in the center is the 10-year moving average. This is one standard deviation below that average, two standard deviations below, one standard deviation above, and two standard deviations above. So the first thing I would want to point out is that the notion of an all-time high requires a little bit of clarification, because if you look at the Sensex PE, the all-time high of the Sensex PE was about 55 to 60 during the Harshad Mehta scam in the early 1990s. And one investor who I respect said that just before the 2008 crash, the Sensex PE was actually much lower than what it was during the Harshad Mehta scam, or just before the crash associated with the Harshad Mehta scam. So he said at that point in time, investors were not worried about the 2008 impending crash, because they thought the PE was actually lower, and so they did not worry too much about it. But we know things turned out to be different. And please recognize that the historical PE has very little consequence with respect to determining the future of the market, and whether the PE is high or low or medium or whatever you want to call it, if the market loses faith in the system collectively, then the market will crash. Now, if you look at the center line here, which is the 10-year moving average, in January 2009, the 10-year PE average was 17.7, and that has steadily increased to 22.3. So the idea of what is a low PE, what is a high PE has been changing day to day. So all this formula and all all these notions are to be honest, very silly. Now, after the recovery from the 2008 crash, the Nifty PE quickly increased and hit the second band here, two standard deviations above average band right here, and then it corrected sharply. But if you think that's some kind of indicator, you can see that there, in January 2018, September 2018, and May 2019, the +2 band, that is the two standard deviation above band, was breached, and then there were minor corrections, so to speak, but that's something that you only know in hindsight, whether it's a minor correction, major correction, or something. In real time, it's simply impossible to understand what's happening. The only firm conclusion that anybody can make is basically just stating the obvious. When the PE is very low, buy, and you can see that this was a definite buy indicator, this is a buy indicator, that's a buy indicator, and so on. When the PE is low, buy, then that's obvious. So that's like saying when the market is low, buy, which is not a big deal anyway. This is the similar analysis with the Nifty price to book value, and you can see here, compared to the PE, at least in the last decade, the change in the PB has not been much. And you can see what is a low PB has changed significantly in the last decade. So what was it? Was the average was high here, and then it has dropped down significantly, the 10-year average. And if you look at the PE chart, it looks like the market is extremely overvalued. But if you look at the PB chart, then you can see that the current PB is more or less comparable to the 10-year average is basically at the 10-year average, and there's not much of, and you can say it's a market is fairly valued. So it's basically, blind people touching an elephant and each one of them saying something. And if you look at the equity valuation index of ICICI mutual fund, which is published each month, there will not be much change in the signal. The signal will not fluctuate too much, and that's probably because they are relying more on the PB than the PE. Now the main question is, will the market crash because the Nifty PE is at an all-time high? Now, honestly speaking, nobody can know. And if you are interested in some backtests, I actually have done backtests on with the PE ratio. There is this tool, there is this article called Market Timing with the Index PE Ratio, Tactical Asset Allocation Backtest Part 1. In fact, I have, if you go to freefincal and if you go to the scroll down, this is on desktop, if you go to a category and there is a category on tactical asset allocations, I have done tactical asset allocation backtests for many metrics and so on, and the only metric that gives you more returns, if not less risk, is basically a momentum strategy. It's a dual momentum strategy based on 6 months moving average and 12 months moving average. I have a tool for that as well, and this is the one, which is the tactical buy sell tool, which is right on the menu. You can consider getting that tool if you are interested. But if you are going to use the PE ratio, you will get lower risk more often than not, higher returns. Sometimes you may get, sometimes you may not. I have shown that using the Franklin dynamic PE fund. That was before all this problems came with closure and so on. And but also the fund has changed its strategy from by including PB in its strategy, but that's a different matter. But if you are going to use the price to earnings ratio, what has happened in the backtests is that pretty much you are guaranteed to lower risk in the portfolio, but higher returns are not guaranteed. This whatever I just said about dual moving averages and using a momentum indicator, that is not a low risk strategy. It's a higher risk, higher reward strategy, but it has worked more often than not, as you can see from the study yourself. I think this one, I have this article is this buy sell market timing strategy surprisingly work. This article you can this was written on June 2nd. You can have a look at that with respect to the back tests. So so in summary, a high PE doesn't mean there's going to be a crash. You better have if you are going to say that I want to time the market, then you better have a solid strategy which is back tested. Please don't sit and say this is common sense, this is intuition, I have been trying this method, it has given me good results. I get all sort of comments without any kind of analysis, without any kind of data. My analysis tells me something. Show the data, right? I'm showing you analysis. If you are sitting and saying my analysis is showing me that, who knows what analysis you did unless you publish it or put it outside, who's going to take you seriously, right? So my suggestion is, my humble request to young earners is, please don't try and time the market if you don't have a proper strategy. Most people talk a lot, they sit in personal finance forums and talk this and that, but they don't have a proper strategy. If you don't have a proper strategy, please don't sit and think when to invest. When shall I invest? Shall I invest now? Shall I invest at Nifty 5,000, Nifty 10,000? Waste of time. Please invest systematically if you don't have a strategy, and that's probably the best strategy I can think of, and that's what I'm doing. My job as an analyst is to produce these results and produce these tools, but I have also shown that you don't need to use these tools. Nobody looks at that. They think I'm trying to sell some tools, but I have also written that there's no need to time the market. That nobody sees. But anyway, that's life. So either you have a plan or you invest every month, and at the very least, look at your goals and see where you stand with respect to your corpus. Don't worry about high PE, low PE. Markets will crash whenever they want to.